It's getting close to the end of the year and the markets are up big. What should you do? Normally, as you know if you've watched my previous videos, I'd tell you to do nothing. But this year, if you're overexposed to equities with more than 60% exposure, or worse yet, 80% to 100% exposure to equities, this could be a great time to rebalance your portfolio to include at least 40% long-duration U.S. government Treasury exposure. Of course, if you're in a taxable account, talk to your accountant before you make any moves that could cause you to have to pay taxes, or worse yet, bump you into a higher tax bracket. But if you're only dealing with non-taxable retirement accounts, then rebalancing by increasing your exposure to Treasuries might make good sense. The equity markets are up big for the year, as you can see right here, and this could be a great opportunity to shift some of your exposure away from equities and into long-duration U.S. government Treasuries. But given all the headlines suggesting you make moves in your portfolio at this point in time, it's important to keep this wisdom from Tom Sosnoff in mind. Link in the pinned comments below. Tom is the billionaire who developed and sold Thinkorswim and Tasty Trades. Here's what he had to say about knowing what the markets are likely to do, and I agree with him.
What's the best trade that you've ever made?
The best trade ever. Well, I have a best story about a trade ever. Okay. You're probably how old are you?
36.
You're too young. You remember Desert Storm?
Yeah.
Okay.
Well, I know what it is.
Yeah, right. So there was a kid that used to clerk in the OEX pit, which was the S&P 100 at the time. And he always wanted to be a cameraman. And he got a job. Clerking on the floor of the exchanges was kind of like a low-paying job. You're hoping to get a job as a trader. Well, this kid didn't want to be a trader. He wanted to be a cameraman. He got a job to go to the front lines in Iraq and with CNN this was like the first televised war.
Okay.
And this kid was like standing behind us for like 2 or 3 years. And we get a call literally from the front lines in Iraq. He goes, "We're going to war tonight." Okay. And the whole pit, within 2 seconds, but everybody else had known it too. We just didn't watch news.
Yeah.
We didn't know the whole world already knew this. And so, but we thought we were like, so everybody in the pit, 400 or 500 guys are all fighting over each other, trying to buy every put they can get their hands on, thinking the market's going to crash tomorrow morning. And some broker that was standing next to me, because when you're a trader, you can't be a broker. You have to be one or the other. Some broker standing next to me sold me like a 50 lot of calls that were in the money because he couldn't get rid of them. And he said, "You got to take these for me because I owe the customer Phil." So I took the 50 lot of calls. I'm buying like as many puts I can get my hands on. I took this 50 lot of calls. We're all got giant short that night, thinking the market's going to crash the next day. We opened lock limit up the next day. After everything was televised the night before, we opened lock limit up. That 50 lot of calls
paid for everything else. No,
it paid for like the whole year. And it was insane because I didn't want that trade. Yeah. I would have given it to you for like a $10,000 loss, but I couldn't find anybody to take it from me. And that whole trade was like probably the best single trade I've ever made.
Why do you think that it went up when everyone thought it was going to go down?
Because nobody ever knows anything. It's the beauty of markets. The greatest thing about what we do is that absolutely, I don't care how long you've been doing this. If I've been doing this for 40 some odd years and somebody had never looked at the market before and you said, "What's XYZ going to do tomorrow?" I have no better chance than that person does of knowing what it's going to do.
Why move into long-duration U.S. government Treasuries, you ask? Well, we're at a rare junction point where interest rates are still high, and the Fed will likely continue to lower them over the next 6 to 12 months. Why do I say rare? Well, looking at this graph of the Fed funds rate in the black line here, as you can see, and the 10-year Treasury note yield over the past 37 years, this light blue line, you can see we haven't been in a situation like this with high interest rates since 2007, 2000, and off the chart to the left in the early 1980s. Owning long Treasury bonds in your portfolio can benefit you in two ways. Look, we're currently at an inflection point right here, where if interest rates continue to fall, long duration Treasury bonds should move higher, which means the yield should fall. So you can see that short interest rates are falling. Why? Because the Fed's lowering interest rates and they control interest rates at the short end. But you can see that the 10-year note has stayed stubbornly high up here north of 4%. Now, what will happen if the Fed continues lowering rates? Well, let's look at previous history. Let's look at back here. The Fed kept lowering, and what happened to the yield on the 10-year Treasuries? They fell. In fact, they fell a lot. So as yields fall, the value of these bonds goes up, which is good. Now, what's a second reason that long Treasury bonds can benefit you? Well, let's take a look at what happened back here in 2000 as the Fed lowered rates. Now, the markets, the equity markets, were also dropping. This was the dot-com bubble. And as the rates went down, look at what happened to the yields on 10-year Treasury notes, this light blue line. You can see they plummeted. And how does that benefit you? Well, as these yields plummet, the price of these bonds goes up. So if you're holding equities that are falling and these bonds where the yields are falling, but the value is going up, you will benefit. Now, let me show you that with some real numbers here. Let's put 20-year Treasury bond ETF on here. Now, unfortunately, this doesn't go back to 2000, but let's look at the next time period where interest rates dropped and the equity markets dropped. What happened as the 10-year yield plummeted? Well, you can see that TLT, this dark blue line, which is 20-year government Treasury bonds, you can see that it went up and then shot up as equities plummeted. This, being in your portfolio, helped offset some of this risk. What about during the pandemic? Well, during the pandemic, you can see the equities dropped 34 to 36%. And what happened? The Fed really dropped interest rates, and you can see that the 20-year went up through the roof. So again, this offsets some of this risk in your portfolio. Now, the one time this won't work is when the Fed's raising rates like a maniac, like they did back here in 2022. You can see that equities fell, and you can see that long bonds fell. So there was nowhere to hide. But this situation is highly unusual and hasn't happened since the late 1970s, early 1980s. So this is a rare instance and won't be normal, hopefully, as we go forward. So where are we now, though? Well, you can see, as I pointed out earlier, the Fed is lowering rates, so short rates are coming down, and 10-year yields have actually been going up. Now, eventually, as the Fed keeps lowering, these 10-year yields are going to start to drop. And as they drop, the price of these long bonds will start to rise. And how does this present an opportunity to you as an investor? Well, as I said, two reasons, right? One, long bonds tend to offset the equity risk in your portfolio, so there's some protection there. But look where we are with TLT. It closed Friday at $93.97 with a 10-year Treasury notes at about 4.18% or so. So we're right here, basically. Now, if somehow interest rates were to go up and these bonds were to drop, your downside is very limited here. So if you go to the extreme here, the lowest price on this chart, you're talking about a 10% maximum loss if things really get bad. But with the Fed lowering rates, it's highly unlikely that the yield on these 10-year Treasury notes will actually go up to 5% or even close to 5%. So your downside's very limited, minus 10%. And by the way, these pay a roughly 4% dividend currently. And if they do fall in value, the dividend yield is going to go up even more. So that's going to help you recover this 10% if, in fact, the worst case happens and these things actually drop in value. Now, let's look at the potential upside. So we've established we have very limited downside, But look at the upside. If the yield on the 10-year just goes to 3.5%, you're talking about potentially a 9% increase in these long bonds. Those are equity yields over the period of a year, and this could happen in shorter than that duration. Now, what if yields on the 10-year drop below 3%, let's say down to 2.67%? Don't ask me why I picked that number, but you can see that what you end up with there is a 19% increase in the value of these bonds. And by the way, that's in addition to the dividends you're going to collect every month. Now, if things get really bad and the Fed really lowers rates back toward zero, which is what they do when things are bad, you can see that there's very, very big upside here with TLT. But look, if you can get 9% to 19% out of this over the next year or two, that's fabulous, plus the dividends. Now, if you want to go a little bit longer duration and invest in the Vanguard ETF EDV, this one has roughly, I think, a 24-year duration instead of 20 years. You can see that the downside is a little bigger. It's 15% instead of 10%, but the upside is much bigger. So now we're talking about 13% upside here instead of 9%, and we're talking about a very large 34% potential gain if the yield on the 10-year just goes down slightly below 3%. It's clear from this analysis that we're at a unique point in time where equities have appreciated well above their normal annual returns of 9 to 11%, as you can see here. And long Treasury bonds have been beaten down because of high interest rates, as you can see here. I'm not saying equities will fall from these levels, but if you have little to no exposure to long duration Treasury bonds in your retirement accounts, then now might be a good time to rebalance at least 40% of your portfolio into the ETF TLT, this orange line, for 20-year duration Treasury bonds, or the Vanguard ETF EDV for even longer duration Treasury bonds, represented by this purple line. These Treasury investments currently have a limited downside risk and very large potential upside gains. Are you currently holding Treasury bonds or Treasury bond ETFs in your portfolios? Let me know in the comments below. And if you're not, do you plan to shift some of your assets into these safer investments? With all that, let's go through the current health of the stock, bond, gold, and crypto markets. So as you can see, over the past week, equities have done very, very well. ARK Invest is right up here on the top, followed by small caps. Now the Dow comes in third, which is not great. I'd like to see the NASDAQ come in third or second. And then you've got the S&P fourth and the NASDAQ dead last. So the NASDAQ seems to be taking a little bit of a breather here. What about over the past month? Well, very same picture. ARK Invest way up on top, small cap second, Dow third, S&P fourth, and NASDAQ dead last. And then if we jump to 1 year, because we're almost there year to date, so we'll just jump ahead to 1 year, you can see we've got, let's see here, it's pretty close. Small caps are on the top, NASDAQ 100 second, S&P 500 third, Dow fourth, and ARK Innovation dead last. But you can see that ARK Innovation is just ripping higher here. And how does this show up in the bottom dynamics? Well, I like what I see here. You can see we've had a fairly nice soft rally over the last couple of months, a little bit of a dip here and a big bump here and so on. But these numbers are trailing in the right direction. I like the fact that the bottom confirmation signal is up here at 100%. Now the confidence level, this black dashed line, is fairly low right now. It's below 80. It is pointing higher. So the equity markets aren't moving in herd behavior, but you know what? That's okay, because the problem is when everybody runs one way, it usually happens at extremes, either extreme tops or extreme bottoms. So I'm not upset that the confidence level is down here below 80 and moving higher, while this bottom confirmation indicator is up here at 100%. I'm comfortable with that. And how does risk versus opportunity look? Well, again, this looks fairly good. You've got risk acceleration way down here at 30, pointing down. Risk, which is a laggy indicator, below 40 and pointing down. Very happy with that. In general, I like the fact that opportunity level and opportunity acceleration are both above risk and risk acceleration. So they're up here at 60 and just a little bit below 50 and moving lower. So this looks very, very healthy going forward. What about equity versus safety? Well, let's jump right into the overlays. You can see that nothing for equities has changed since last week. We have small caps ranked first, Dow second, S&P third, and NASDAQ last, very much like the graphs that we looked at a little while ago. You can see the cash is staying flat right here in the middle position of this table. And what about safe haven assets? Well, I really like what I'm seeing here. You can see again the cash has stayed flat, but look at what's happened. We had treasuries in an unhealthy relationship here with longest duration treasuries, EDV, ranked 9th, followed by TLT in 8th, intermediates in 7th, and short duration in 6th. Well, what's happened since then? So since last week, now EDV is up here just below cash. TLT is in second place, if you think about it that way. Intermediates have fallen to 9th. And short duration treasuries are down here at 8th. So this is starting to look healthy. And I hope it means that treasuries, long bonds, are going to continue moving higher over the next several weeks. How does all of this show up in the buying and selling pressure for equities? Well, you can see we've had a nice upward move. It hasn't been straight up. It's been kind of rocky for all of the indices. But you can see that the buying pressure has been oscillating between being up big, followed by a pullback. That's what happens when the buying pressure gets way up here. And then another rally. Now, again, buying pressure is up here fairly big. So are we going to pull back next week? We'll have to wait and see. It kind of looks that way to me. Similar picture for the S&P 500. Big buying pressure falling off and then rising again as the price rises. NASDAQ 100, very similar picture. Small caps, very similar picture. And then if we look at ARK Invest, again, a similar picture. Big spike in buying pressure. That usually gets accompanied by a peak and a pullback, which it did. And then you can see we're moving higher again as the buying pressure moves higher. So this looks very good. Now let's take a look at sector rankings. Well, they don't move much. I'm telling you, when you look at these sector rankings, they don't give you much of an indication where things are. They're kind of a look into the rearview mirror, as you've heard me mention before. So now let's take a look at sector rank acceleration. And why do I like these? Well, I like these because they move much more quickly and give you more of a sense of where we are or where we might be going. So what looks good on this table? Well, not much. You can see there's not much moving higher here. Emerging companies, small caps, moved up very nicely into first place. I'm not surprised given all the performance metrics that we've looked at so far. We had the Dow Jones moving up higher. Now, this is good because they're equities, but it's bad because they're safer equities. Same is true for consumer staples. Again, equities moving higher, but these are safer equities. You really want to see riskier assets moving higher, not safer ones. And then emerging markets, which really have been just down here, as you can see, near the bottom of the table, moved up as well. Now, what doesn't look good? Well, a lot, unfortunately. You can see there is a lot of red on here. You can see that Bitcoin moved way down from first all the way down almost to the middle of the table. ARK Innovation went from second to last. That's insane. The NASDAQ 100, we know this hasn't been performing that well from the tables and charts we've been looking at. So that has moved from up here all the way down. Why am I losing it here? That has moved from up here all the way down to here. Not good. Clean energy moved quite a bit lower. You've got the S&P 500 moving slightly lower. You've got XLK and semiconductors both moving lower. And you've got consumer discretionary moving down one notch and cash moving up and treasuries moving up, which is somewhat either a flight to safety or a flight to opportunity because these have been so beaten up that investors are starting to put their money there. And speaking of treasuries, how have these looked? Well, over the last week, they look really good. Look at this. You've got EDV, the longest duration ones, right on top, followed by 20-year, and then right down the line for duration. So this is very good. This is a very healthy appetite for treasury risk and duration risk. What about over the past month? Well, if we look back over the past month, you can see that we were kind of in a negative situation here, but recently, as you saw over the past week, this has become very, very healthy for treasuries. And then if we look back over the past year, you can see that they've been all over the place, but more recently have been really shooting higher very quickly. So hopefully this trend continues and these perform very well over the next several months. And how does all of this show up in the buying and selling pressure? Well, you can see in all of these cases, we've had a downtrend over most of this previous 2-month period. But then sort of the middle of November, things started to turn around and treasuries in general started to move higher. Now, was there a tell here? Well, yeah, if you've watched my previous videos, and I'll put a link in the comments below to my video from last week, you can see that we've had a declining price, but we've also had declining selling pressure over that same period and rising buying pressure. So this is a divergence, and it's not only a divergence, it's a very long divergence, multiple weeks here. In fact, probably more than a month of declining price, declining selling pressure, rising buying pressure. So that can't continue forever. And what has happened, in fact? Well, the price has turned higher. In all cases, it's moving higher. So, given how long this was, I'm hoping this rally lasts for more than just a few days, but we'll see. And how's the yield curve? Well, the yield curve is just slightly not inverted. 1.29 basis points positive. That's not much. And you can see where we were a year ago, this light blue line. The 1 year was at, over 5%. So short duration interest rates were quite a bit higher, and they've fallen since. Now the dark blue line is where we are today. So today on the 1 year, we're currently at about 4.291%. And then if we go out to 10-year, we're currently at about 4.18% if I round it. And a month ago, we were quite a bit higher. So these yields have been coming down, which is causing the prices to move higher, as you can see here. And what do the markets think the Fed's going to do when they meet in just a couple of weeks? Well, it looks like this is going up. 68% probability that the Fed will lower rates by 0.25%. Now you can see last week that probability was lower at 54%. Now, what if we go out to January? Well, if we go out to the January meeting, there's still some probability the markets think that the Fed could leave rates where they are. I personally don't think that's going to happen. And then you can see there's almost a 60% likelihood the rates will be lower by 0.25%, but there's a growing likelihood that rates will be lower by 0.5% by then. And what if we go out to the March meeting? Well, if we go out to the March meeting, you can see that now things are tilting, certainly to 0.25%, 0.5%, and some think possibly 0.75% lower than where they are now. And what about gold? Well, gold has basically gone nowhere over the past 2 months. There's been a lot of geopolitical risk and tension, a lot of uncertainty in the world, and you can see that gold has responded to it and then sold off, and now it's been recently moving higher again. So not much happening here. And what about Bitcoin? Well, Bitcoin has been just on a tear. And you can see that the buying pressure went off the chart here just about. I mean, this is an extremely high level of buying pressure. And of course, it didn't last. But what's interesting is that when it fell off dramatically, the price didn't pull back that much. And in fact, continued higher as the buying pressure continued to decline. Now, just like in treasuries, this can't continue forever. Declining buying pressure, rising prices, increasing selling pressure, that can't go on forever. So what's going to happen this week? If I were going to make a bet, I'd say This is probably going to pull back. In fact, it's already started to here a little bit. But, this could turn around. Buying pressure could kick up again and price could start moving higher. So no way to tell, no way to forecast it, and there's no crystal ball. It's clear from this analysis that we're at a unique point in time where equities have appreciated well above their normal annual returns of 9 to 11%, and long Treasury bonds have been beaten down because of high interest rates. Look, I'm not saying equities will fall, but if you have little to no exposure to long-duration Treasury bonds in your retirement accounts, then now might be a good time to rebalance at least 40% of your portfolio into the ETF TLT for 20-year duration Treasury bonds or the Vanguard ETF EDV for even longer duration Treasury bonds. These Treasury investments currently have limited downside risk and very large upside potential gains. Are you thinking about rebalancing your portfolio to lock in some of the big gains we've seen over the last couple of years? Or do you plan to let your gains ride over the long term? Now, hopefully you already have a fairly healthy exposure to Treasury bonds in your portfolio, but if you don't, are you thinking about adding some and increasing your exposure at this point in time? Please let me know in the comments down below. As you can see from the price movements and metrics, the equity markets and treasuries are looking much better with an improving appetite for risk on both fronts. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.